obviously I wanted to make money, right? I wanted to be kind of this like genius stock trader and be able to say, hey guys, look, I turned my $1,000 into $50,000 within 2 weeks. I think a lot of people are frankly very ignorant about the stock market. And I'm grateful that I had this $10,000 lesson, but I did the math of, kind of the opportunity cost math of how much I could have in my portfolio if I would have just started out the right way. And it was something like, instead of my account being 75,000 right now, it could have been 135,000. I had this mentality that the stock market was kind of like this magical ATM, right? Where you put $1 in and then the next day it'll be $2. Just kind of took a deep breath and said, this doesn't work, right? I need to completely change my mentality. I need to completely change my strategy and do what I know works.
Investors, welcome back to another go-round of Masters of the Market, bringing to you all the insights and brand new dividend stock or stock ideas. Every single week, I have with me a guest on the show here, Masters of the Market. And this week, I am incredibly excited to have on with me Davis Watkins, who our initial conversation essentially started off with Davis saying he's made some costly mistakes as an investor earlier on. And we're going to get to those mistakes and much more right now here on Masters of the Market. So Davis, I first want to just welcome you to Masters of the Market and say thank you for joining me. I want to go ahead and ask you, what's your story? What's your background? How exactly did you get here today?
So yeah, my story is actually kind of a funny one, kind of an interesting one. It's kind of the classic story of someone who knows next to nothing about stocks or the stock market or how anything like that works, but just kind of throwing money into stocks, hoping and praying that they go up and kind of failing. So I started investing, trading. I'll put that in quotation marks. About 7 years ago, I was in college, and basically any extra money that I had from working in part-time jobs or maybe extra money from grants or scholarships, I would basically just toss into the market, right? I would just throw it into random penny stocks, random meme stocks. The only thing I knew about trading or investing was that when you buy shares of a company, you're just buying, part of the company, and that's about it. So I just knew that, if I invest into a company that, maybe it'll go up, maybe it won't, but I'm just going to hope that it does. So as you can imagine, it probably it didn't end well, right? It's not a great strategy. So I had a few $1,000s at a time. I would throw it into a penny stock or a meme stock, and it would go up 15%, and I would cash out. And I'd be like, great, this is awesome. Kind of that gambler's mentality, right? Of hoping that, you put your money into something that it'll just go up. So made a few wins, but ultimately I mostly lost, as you can imagine. Most traders do, especially when they're beginning and they don't have any idea of what they're doing. So I had at one point I was up, $5,000, and then I would lose $10,000. So I grew my Robinhood account to about $10,000 to $15,000, and then towards the end it just eventually went down to about $2,000 or $3,000. And at one point, my whole account was down 75%. And this went on for a while too. I was very stubborn about it. I just thought, hey, I've made money before. I can make money again, right? Just kind of that gambler's mentality. So eventually so my mindset, as you could tell, was very off. My mindset and understanding of the stock market was very off. Basically anything wrong that you can think of, the wrong way to do it is what I did, right? I would panic sell. I would, just play the hope strategy, right? Where I would just put money into something and then cross my fingers, hope that it goes up. So I was very stubborn about it. This went on for a couple of years, to the point where, again, I was down about 75% in my Robinhood portfolio. And then at that point, I just thought, okay, this obviously doesn't work. I need to change my strategy. I need to change everything so I can actually make money doing this. And so I had this mentality that the stock market was kind of like this magical ATM, right? Where you put $1 in, and then the next day it'll be $2, right? It'll spit out $2 after you put in your dollar. And obviously that's kind of the wrong way to approach it, right? So eventually I'm down 75%. I have $2,000 left. It went from 15,000 to 2,000, and just kind of took a deep breath and said, this doesn't work, right? I need to completely change my mentality. I need to completely change my strategy and do what I know works. And that's when I started getting into, dividend investing, long-term dollar cost averaging into quality companies, into diverse low-cost ETFs, just kind of going through that whole studying and researching and learning about the stock market, kind of a little bit more about like Warren Buffett, some of the great super investors of our time. And from there, I've just kind of built my portfolio back up from, changing that strategy and changing my mindset about it and focusing on the long-term approach. And since then, I've been able to grow that Robinhood account from $2,000 to $3,000 up to now just under 75,000.
Heck
And
yeah, man.
so that was, let me see if I can get the timeline right. So my kind of trading and gambling in the stock market lasted for like 2 or 3 years. And I made that switch about 2 years ago. And so now here we are. I guess the rest is history, right? And now I'm focusing on building, solid wealth over time and focusing on the long term. So
I,
it's
I
been an awesome journey.
I love it, man, because a lot of the times, and especially on YouTube, as I'm sure you know, is you have a lot of creators or a lot of investors who just share their wins. And it's just not realistic. So what I love about your story is you're actually just very open about the lessons you've learned or these mistakes, right? And I wouldn't even call them again mistakes. They're just these lessons that you have now to share. And I want to go into some of them and just ask you now, first of all, how did you know when it was time to actually forgo that gambling strategy and shift gears a little bit more into a strategic or longer term approach?
Yeah, that's a good question. So I wanted to make money, right? I wanted to be kind of this like genius stock trader in college and be able to say, hey guys, look, I turned my $1,000 into $50,000 within 2 weeks, right? That was kind of like my goal, was to be this like, sophisticated, cool day trader, right? That could, buy into a penny stock and flip it and, again, make that 50K in a week, right? That was kind of my goal. And I guess reality kind of set in after a couple of years, and I just thought to myself, this doesn't work, right? And some of the smartest people in the world maybe can beat the market by 1 or 2%, right? These hedge fund managers or these genius investors, a lot of them can they can still beat the market. They can do really well, but even the smartest people in the world, they still lose when they day trade. They still lose tens of thousands of dollars. And I just thought I have nowhere near the experience that these guys have. And I just thought any average Joe, any normal person that has very little experience in the stock market can make a lot of money over time. It's just not realistic to think that you can turn $1,000 into $50,000 in a week. Some people can do it. Some people are really have a lot of experience and have a lot of expertise in that field, but I realize that's not me. I'm not a trader. I'm not a gambler. I'm not someone that can spend 15 hours on a screen or multiple hours looking at a screen doing technical analysis and you know getting all the right price points and everything and making thousands of dollars. That's just not really me. I've no experience in that. So I just thought to myself, I'm an average Joe. How can I make money in the long term? How can I build wealth and do it the right way? And I kind of landed on, the right way to do it: dividend investing and dollar cost averaging over time. And I also kind of got to the point too where I thought, I'm graduating soon from college. I'm going to have a full-time job sometime soon, and I'm going to be able to, you know, invest on a regular schedule on a regular basis. And I can't afford to, once I start making a lot of money, I can't afford to lose $15,000, $20,000 at a time. So that was kind of another part of it too, is I thought I'm going to be making money sometime soon. And I need to be able to keep the long-term mindset so that I can eventually build wealth.
We often all start out with like this risk big, win big type of mentality. And then we realize that, almost like you said, right? Like the stock market is not an ATM. And I'm curious though to know from your standpoint, just because you've had all of these lessons very early on, it sounds like you really got to know yourself as an investor. So I'll first ask you here, what type of investor would you now classify yourself as if you're not the gambler?
No, that's a really good question. So, I mean, everyone's on a different journey, right? Everyone has their different style of investing. And don't get me wrong, I love dividends. I love dividend investing and reinvesting the dividends back into stocks and ETFs. So I'm kind of a mix between dividend growth, a dividend growth investor, and just pure growth. So I'm a younger investor. I'm turning 27 here within or in a couple weeks. So I'm fairly young, fairly a young investor, and so my focus right now is kind of tech and growth. But of course, I can't imagine anything better than eventually living off a dividend. So kind of my strategy, kind of my plan right now is obviously focusing on consistently adding money into the market, buying the stocks that I find are quality, that are great to have in my portfolio, and hoping to continue to grow my portfolio into the hundreds of thousands and hopefully into the millions over the next decade or so. And then once I can grow that account to a certain number, whether it be 1 million, 2 million, that's when I'll completely switch to full-time dividend investor, where I'm completely either living off the dividends or continuing to reinvest the dividends and keeping that dividend snowball. So I guess to answer your question, I'm kind of a mix between dividend growth and pure growth.
Sure. Surefire way to marry the two. And I think it's especially right, younger investor to do exactly what you're doing. It makes a lot of sense. I too have growth stocks in my portfolio, though I'm really only talking a lot about the dividends. I want to go back to some of these mistakes here and ask you if you think they were necessary for you as an investor, or even for all of those who are listening. We often learn the best from the University of Hard Knocks, is what I found. But I'm curious
Yeah.
to know if if someone, maybe you had a mentor, if you had, a plethora of books to read, do you think that would have done, the same for you in terms of lessons learned, and or if you had extrapolated that wisdom? Were your mistakes necessary for you to get to where you are now?
Yeah, totally. So I lost a total of, just trading, I lost a total of about 10 to $12,000. And kind of like what you were saying, that's a 10 to $12,000 mistake that I learned, right? It's kind of like spending $10,000 to learn how to invest the right way. So I made these mistakes, but I'm actually extremely grateful for them because now I know not to ever go back to that. Now I know not to put all of my money into one stock, right? To do zero research, zero due diligence on stocks or ETFs and just hope for the best. Now I know not to do that, and now I know what works. And as long as I keep that consistent, as long as I continue to dollar cost average to add capital into my portfolio every month for the next 10, 20, 30 years, I know that in the long term, that wealth will just explode, right? It'll just continue to grow, and I can build this portfolio into a one day $1 million portfolio because I learned those mistakes, right? And again, some people are geniuses at it. Some people can pull it off. Some people can trade and do well, but that's not me. I'm just an average Joe investor that loves to consistently invest. So I'm grateful. I'm grateful that I was able to, obviously it sucks to lose $12,000 within the matter of a day, right? You can literally, if you're trading options and you're doing these high risk strategies, you could literally watch your account evaporate within a day, right? And that's just not me. As fun as it sounds to be able to, make tens of thousands of dollars trading within the short term, as fun as that sounds, to me, it's just not very realistic and not something that is part of my strategy and how I invest, or
Sure. I'd love to
I guess
know, like,
trade.
if you think back to those days where you looked at your account and I don't know, you saw a $5,000 loss. What was that feeling like? So perhaps we can come to understand that feeling, know it when it's in front of us, and pivot before you kind of pivoted 2, 3 years in.
It's probably one of the worst feelings you could ever get when you look at your account. You look at the 1 month, 3 month, 1 year return, and it's down 50, 60, 70%. In fact, I have a screenshot that I might send to you that we can maybe put up on the screen. But yeah, it was down, I think, over 71%. And it's almost kind of laughable too. I remember just looking at it and thinking, man, this is really, really stupid. Like this is not fun at all. It's not fun to potentially have 15, $20,000, but have it only be $2,000. And I did the math as well. I don't remember the exact number, but I did the math of, again, I'm grateful that I had this $10,000 lesson, but I did the math of, kind of the opportunity cost math of how much I could have in my portfolio if I would have just started out the right way. And it was something like, instead of my account being 75,000 right now, it could have been 135,000. Right. So if you look at it in an opportunity cost way, it's actually more than that $10,000 lesson. It's a $50,000 lesson or something, right? So that's kind of what I have to look at is not going back to these mistakes and focusing on what works.
Sure. I should have opened with Davis Watkins graduated University of Hard Knocks at $10,000 worth of a lesson. So,
Yep.
okay, so
The
we learned this $10,000 lesson when it comes to investing, and it surely set you up well now. I mean, you're at $75,000, almost 27, I think I heard you just share. So you're really on track and doing really well, outpacing a lot of other YouTubers, creators, investors who are out there at your age, which I got to applaud you for. And now I
Thank
want to
you.
ask you this question because you are, at least it sounds like, on a much better track. Where exactly should a new investor start if it's not on that gambling strategy?
Yeah, that's a great question. So I guess the way I would start right now, if I didn't know much about the stock market, if I didn't want to do 10 or 20 hours of research a week on stocks, what I really like to do is I like to just start with ETFs, whether it be sector ETFs, broad market ETFs. I would even just start with VOO, right? The Vanguard S&P 500 ETF. And what I really like to do is I like to go into its holdings and kind of just look at everything that's in that index, everything that's in that ETF, and just starting from there and looking at, which companies are some that you might want to invest in, some that are part of a certain sector or a certain category that you want to look into. Um, if you don't want to do that even that much research, because that might take a couple hours to go through each stock in its holdings. Even just start with an ETF and just buy one share, or if you don't have enough to buy one share, buy half a share. A lot of these brokerages can allow slices of shares or fractions of shares. Even if you have $100, I would just start with a broad market ETF like VOO or VTI, and then just kind of go from there, right? I wouldn't, like I said, I wouldn't want to jump too much into trading individual stocks if you are a brand new beginner, a brand new investor. But yeah, so I guess to answer your question, start with ETFs and go from there.
How do you know when it's time to, we'll say, move on from ETFs? Not that you ever really move on, at least I haven't
Yeah.
fully from ETFs and start to invest in some dividend stocks or growth stocks individually.
Yeah. I mean, like you said, sometimes some people, depending on their goals and what they want in their portfolio, sometimes it's fine to just hold, 5 or 10 different ETFs. But I think for me personally, I think it's kind of fun to go into research different stocks and to figure out, their market cap, the PE ratio, maybe even go into like their financials and look at cash flow and debt and revenue and all that. Um, but I don't know. I think eventually, if it just kind of depends on what you want to do with your portfolio. I see nothing wrong with having both individual stocks and ETFs. And, this kind of comes up, or this kind of brings up the question of, is it better to just hold ETFs or to have 100 different stocks in your portfolio? And I don't know how to really answer that other than to say that it just kind of depends on what you want. So I'm the kind of investor where I like to have a mixture of both. Sometimes I might be a little too diverse where I have too many stocks in my portfolio, but it kind of just depends on what you want in your portfolio. But I see nothing wrong with having a good mix between stocks and ETFs and kind of picking and choosing what you want in your portfolio, obviously without taking on too much risk.
Davis, how many stocks are in your portfolio right now? What's the portfolio breakdown look like?
So yeah, my problem is I like too many companies, right? I want to invest in too many companies. So, and again, this is all kind of subjective. It depends on how many you want in your portfolio, right? It's very kind of, I guess, debatable and subjective, but I have about 40 or 45 in my portfolio, and that's including ETFs as well. But again, my problem is I'll find a company that I really like, that I really think is maybe undervalued or has a good forecast going forward, and I'll add it to my portfolio, right? I'll buy one share or two shares, and then the next day I'll find another company that I really like that I'll want to, add to my portfolio as well. So my problem is I really like to do research on stocks and find different stocks, especially the ones that aren't very popular, that are still, undervalued and aren't very risky. So yeah, I have about 40 or 45 right now. It kind of hovers between that range. And I talked about this in one of my recent videos when I did a Robinhood portfolio update. Is right now I'm a little bit stretching myself too thin. So I might consolidate some more this year and just kind of focus on, instead of 40 or 45 different stocks, focus on maybe 15 to 20. But again, it really just kind of depends on how closely you want to watch your assets in your portfolio. Because you're obviously going to be wanting to watch them fairly closely. It might be hard to have over 100 in your portfolio to kind of watch all those and keep track of them. So I don't know, it just kind of depends. For me, my max is about 50, but if you can handle keeping track of over 100 in your portfolio, As long as you're fairly diverse, I see nothing wrong with that either.
Sure. This is a great time now for me to share with everybody that if you haven't checked out Davis's channel right after this chat, go check it out. Talk about insights. You'll find a ton of them there. And you have a love for breaking down stocks and going over different companies. Investors, I'm telling you, you got to head to Davis's channel. We'll get back into it here with a follow-up question regarding the size of a portfolio. And I want to ask you if you think there's a magical number. So you're around 40, 50 holdings within a portfolio. But then you also said that you feel like sometimes you spread yourself too thin. I was at one point very similarly to you. I had, I think just around 40. That was in 2020. And then I started to trim. And for me now, like the smaller my portfolio, the better. It's definitely can get volatile at certain times. But I like that approach better. I'm curious to know, do you think there's a magical number there for holdings that a beginner should aim for that we can realistically manage?
Yeah, for me personally, that magic number is around that 40 to 50 range. If you have too many, it might be kind of hard to manage. Even with 40 to 50, sometimes frankly, I'll be scrolling through my holdings and I'll be like, wait, I don't even remember buying this, right? So I think it just depends on how closely you can manage and watch your holdings. But yeah, I'd say if the magic number would probably be around yeah, around that 40 to 50 range. But some people might only have 10 in their portfolio, right? 10 that are 10 different sectors or 10 different categories, and they can watch those closely. And like you said, it will be a little bit more volatile if you're less diverse. If you have less holdings in your portfolio, you'll experience more volatility that for some investors, especially younger investors, they might not like that. It might be something that kind of scares them because sometimes people don't experience volatility. So it just kind of depends on yeah, how many you want in your portfolio. But I think that magic number would probably be around 40 or 50.
Let's get to it here with your portfolio. What would be like the breakdown, the percentage wise, perhaps of growth stocks in there and dividend stocks?
Ooh, I haven't really, I don't know if I have the exact number, but I would say it's probably around 70% growth in technology and software stocks, and then 30% pure dividend income ETFs or dividend stocks. So right now I really love the covered call ETFs like JEPI and JEPQ that I talk about quite a bit on my channel. Those are some of my favorites. And then, there's obviously we all know SCHD is
Of
kind of
course.
the golden child of the investment community. So I have a couple shares of SCHD. I'm trying to build up my JEPQ position. Um, but I kind of go back and forth. Sometimes, year by year, I think to myself, like maybe I want to put a little bit more into dividend paying stocks and ETFs. And then other years, obviously, last year was great for tech and growth. So now going into 2024, I'm thinking maybe I want to put a little bit more into tech and growth. But as a younger investor, kind of the beauty of it is that you have a lot of time to be able to figure out which type of portfolio you want. Like I always tell myself, whenever there's volatility, because I'm invested so much into tech and growth, whenever there is volatility, I always have to kind of tell myself, okay, my portfolio is down 15 or 20% right now because of the macroeconomic conditions, but my timeline is literally 40 years, right? So I think right now, for me personally, it's a little bit more focused on growth. But I do like to look for, even when they are tech and growth stocks, I do like to look for if they pay a dividend or not. Sometimes that is a determining factor on whether or not I want to add it to my portfolio, because I do like to have dividends in my portfolio or dividend paying companies in my portfolio no matter what. So a good example would be like Costco. Costco is a growth stock, but it still pays a dividend, right? We just got that special dividend a couple days ago. And yeah, it kind of just depends on, you know, how you want to structure your portfolio and your age and your timeline and your goals.
So now you were talking about, right, like whether it's overloading the portfolio to get up to that 40, 50 holdings count, or you spreading yourself too thin, whatever it may be. Somewhere in that, though, you have your process, the Davis Watkins process of picking stocks. First of all, I want to ask you, how do you pick a stock? How does that work for you? What's your process?
Yeah, I don't know, it might be too simple of a process, but kind of like what I was saying before, I like to start with targeting certain sector ETFs. So for example, the technology sector ETF is XLK that I that I kind of model my portfolio around a little bit. So what I like to do is as I dive into that ETF, and I'll find, the top holdings by weight, Apple, Microsoft, um, Google, all those different, stocks that are in that portfolio and holdings. And I'll kind of go through all of them. Some of these ETFs will have a couple hundred, some of them will only have, 30. But so yeah, I start with the sector ETFs and kind of determine how I want to structure my portfolio. And so right now, I've been focusing a lot on tech and growth because we've kind of seen this little bit of a correction in the market where last year we had a huge bull market where the QQQ ran up, what was it, 50%. And so now I'm kind of shifting my focus a little bit more back to tech and growth as we've kind of gone into this more, I guess, bullish market. And there's news of rates being cut as well, which is can be a bullish sign. So I kind of start with those ETFs and kind of structure it based off of what my goals are and which type of sectors I want to target. And so right now it's the tech sector. So I've been diving a lot into XLK, QQQ. There's the semiconductor ETF called SMH that I've been kind of doing some research on. So that's one of my favorite things to do is just kind of diving into the holdings of ETFs and starting from there. And then once I find a stock that I really like that I want to add to my portfolio, I'll then do maybe another hour or so of research on that stock and determine if it's a fit for my portfolio and if it will help me to ultimately continue to grow and drive up that growth. Because obviously the goal is to beat the market every year as hard as it can be. It's definitely possible if you structure your portfolio the right way.
Now, when you're looking at companies and evaluating these companies, what are some of like the go-to metrics that we should all have our eyes on or be looking for? What red flags do you look for? What are the green flags?
Yeah, there's a lot of different metrics. There's a hundred different things that can determine if a stock is good. But I just like to keep it really simple. So I might look at PE ratio. I might go into its revenue and its cash flow and its debt. Back to my huge mistake that I made, back a couple of years ago. I remember I bought a company, just a random kind of meme stock, kind of a random company. I don't know if I should say, but it was the company that was a tech stock and it was doing well during the COVID times, right? It's a telecommunications company. So it's a software that companies can use to communicate with each other. It's like B2B telecommunications. And again, I just bought it because it looked fun. It looked like a cool, fun stock to own. And it had gone up, 50, 60% for 2 years in a row. So I was like, oh, cool. It's going to keep going up, right? But this company had like $2 billion in debt and its revenue was like, a couple hundred million, but it was $2 billion in debt. And so that was kind of a red flag that I didn't even care to look at, right? I just bought the stock, bought the company and just, crossed my fingers. Well, this company is going to go up. It's going to go up another 60% and I'll make $5,000 or whatever. So yeah. And that's kind of when it gets a little subjective too, because sometimes you can do hours upon hours of research on a stock and maybe their earnings call didn't go very well. Maybe they missed earnings and then the stock tanks 25% or 30%. There was a stock that it was kind of funny. So I had done research on this certain stock that I added to my portfolio. I bought 3 or 4 shares of. So I think it was, maybe $500 worth of shares. And, I spent maybe an hour or two doing research on this company. And this was probably a week before earnings. And again, I only had a couple $100 in the stock, but it was in my portfolio a week before earnings. They missed earnings, bad earnings call, and the stock plummeted 30% in one day. And I remember just thinking, okay, this is fine because I only have a couple $100 in this stock and it's only, 0.5% of my portfolio. But I just remember thinking, okay, this is why it's so important to diversify, because if I had 90% of my portfolio in this company, I'd be down 30%, right? So that was kind of just a reminder that even when a company seems great in the short term, it might not be doing that hot, right? There might be something that brings that stock price down, just drives it down 20, 30%. But that doesn't mean that in the long term, it's going to recover and, slowly go up over time. And so that was kind of a reminder to me that it's really important to diversify. And again, like we talked about, maybe that 30, 40 different holdings in your portfolio is a good idea because maybe 1 or 2 within that week or within the short term might fall 30%. That's kind of, sorry, I don't even know if that was an answer to your question, but I guess the answer to that question is, it's important to do a lot of research, but it's also important to keep it simple and diversify. And again, depending on what your goals are and depending on what you want in your portfolio, it might just be better to hold on to ETFs if you don't want to do too much research on individual stocks.
Sure. It's always, I think, what I've even heard a lot of investors say, right? Like come around to investing as if you're the business owner, do your research.
Yeah.
Incredibly important. Now, I want to ask you what you think. I mean, you're almost 27 here. You have your experience investing, and I feel like you may feel similar to me, and that there's just a lot of investing mistakes that are made earlier on in everybody's investment careers. They're trying to get rich by Tuesday. I want to
Mhm.
ask you what you think the most common mistakes are for investors, whether beginner investors or more experienced, say like 2, 3, 5 years in. But what do you think some of those most common mistakes are that we should watch out for?
As funny as my story is of trying to trade and losing $10,000, I think it's actually kind of typical. I think a lot of people are frankly very ignorant about the stock market, and I still have a lot of learning to do. I'm still on a journey. We're all kind of on this journey of learning more about companies and learning more about stocks. But I think a lot of people starting out have zero knowledge of how business works, how stocks work, how, financial reports work, right? And they kind of just get into that mentality that I had of thinking that the stock market's literally just a casino, right? If we, just spend 10 or 15 minutes on Wall Street bets on Reddit, and you'll know that people they literally look at the stock market as a casino and think it's just all gambling. And I think a lot of people, especially starting out, kind of get into that mindset of thinking that it's so much easier than it is to just trade and make thousands of dollars. And I think a lot of it too is greed. When someone makes, maybe let's say someone makes $1,000 in a month because maybe we're in a bull market and every company is going up, right? And we saw this during 2020, 2021. I think a lot of people get kind of greedy and kind of cocky and think that, oh, I'm actually really good at this thing called trading or investing. I'm going to take on even more risk and make even more money. And ultimately, kind of like what happened with me, they end up losing it all, right? Because they take on, you know, 2x the risk they had before. Or maybe we go through a little bit of a bear market, kind of like what we saw in 2022, and they panic sell, they sell out at the very bottom. And that's another thing that I did too. When I started out, I would buy high, sell low, right? And I think that's kind of what happens a lot with newer investors and beginners. Is the stock market looks easy at times. It's kind of that saying that says everyone's a genius in a bull market, right? Everyone looks really, really smart when they make 20% or 30% that year. And I think a lot of it is just they get a little greedy and they get a little cocky and think that, they can just start trading options now or start buying into, 3x leveraged ETFs because their other ETF went up 20% the last year. Right. And again, that's what I'm kind of guilty of, right? I started buying TQQQ, right? The triple leveraged QQQ ETF, and just getting into almost, I guess, stupid risk, right? Where it's like it
Sure.
doesn't even make sense because it's so risky. So I think that's kind of what people get into is that mindset of like thinking it's too easy. And I guess kind of to solve that is just being patient, right? As simple as that sounds, Warren Buffett talks about this all the time. You just have to be patient and stick with that long-term mentality, that long-term mindset with your portfolio. And yeah, just keeping it extremely consistent and being extremely patient. And in the long run, you'll build wealth and you'll know what works.
This almost sounds like it's one of those things where it's simple but not easy. So I want to
Yep,
ask you,
exactly.
how can you train patience? How do you even kind of get that muscle memory to not hit the trigger finger of buys and sells in your brokerage account and just be patient?
Yeah, so sometimes I just kind of relate it to, I don't know if this is a good analogy or not, but I sometimes relate it to buying a house, right? Let's say you put down $10,000 on your house. You're planning on having this house for 30 plus years, right? You're not going to buy your house and then try to sell it for more in 6 months, right? It just doesn't make sense. And so that's kind of, again, I don't know if that's the best analogy, but that's kind of the way I look at my portfolio is it's worth 75,000 right now. There's no need for me to sell it. Why would I need to sell it, right? And a lot of this goes into, if you're going to invest, if you're going to put, $200 a month into your portfolio every single month, you need to know that this money can't be touched, especially, if you're a long-term investor, this money can't be touched for at least 30 years. That's literally what you have to tell yourself. And again, relating it back to the house, you're not going to go try to day trade your house, right? You're not going to buy a house for $200,000 and then plan in 6 months from now selling it for 225,000, right? And maybe some people do, maybe some people do that to make some money there, but that's just not what you're going to do when you're buying a house. So I kind of relate it to that, where it's just you're holding on to this asset for at least 30 years. And then in 30 years, you can do whatever you want, right? In 30 years after you've made, $1 million, then you can sell, then you can use it for your retirement, or just completely live off the dividends. That's when you can kind of, hit that sell button, right?
Sure.
So my strategy, and again, this is probably everyone else's, right, is buying assets right now, buying as much as I possibly can, especially now that I have a job and I'm making a full-time income, taking that, $200 to $500 a month, buying these high quality stocks, these diverse ETFs, and holding on to them as long as I possibly can, and never selling within that 30-year time frame, not selling no matter what happens in the market, no matter what you read on the news, no matter what you see in the macroeconomic. So just, yeah, buying and just planning on never selling.
I love the plan, never sell, because I even that's easy. But there are times that an investor
Yeah.
may need to sell. Do you have your flags ready to go to raise when you have to sell stocks? And what are some of those signs that you perhaps may need to sell or that you have to sell for you?
Yeah, that's kind of a tough question, because like we see it, sometimes we'll find a stock that's extremely overvalued or very, very stagnant, right? They'll go through periods of just, complacency where they just don't really move, or maybe they've slowly kind of ticked down for 6 months, and they might be in your portfolio. And a lot of times people will kind of sell too early, and sometimes they'll sell too late. But I think going back to that patience thing, even when a stock is very, very stagnant, even if it's, flat for even multiple years, that doesn't mean that the next year it might go up 50%, right? It might continue back on that path as long as it's a quality company. So I guess Costco is kind of a stock that I've held for a long time, and it's one that from the research that I've done and just kind of as a consumer of the company, it's one that I'm planning on holding for basically forever, right? Warren Buffett talks about having the forever stocks, like he's held Coca-Cola for however many decades. There's just those forever stocks that, you can keep in your portfolio for basically until you retire, right? Until you forever, literally. So yeah, I think there are times to sell, there are times to hold, and there are times to continue to dollar cost average. And that's kind of what because again, a lot of what investing is can be subjective. Some people are diehard fans of a company or a stock that just doesn't really move. And some people think that, oh, this company, even though it's a great company, they think it's dead because it hasn't grown, and then they sell only to miss out on 20-30% in capital gains over the span of a few years. So I don't know, a lot of it is just kind of subjective in what you think is a great company based off of your own research. That's why in my videos I always try to say, hey, this is just based off of my opinion, based off of the research that I've done. So if you want to go buy this stock or ETF, then spend a couple minutes or hours researching this asset.
I love that advice. And of course, there's a lot of us across YouTube, creators, investors, whatever we want to call ourselves, average Joes, if you will. And for all those who are watching, I feel like sometimes it could be confusing on, who to trust or, what YouTuber, what creator, what investor to go to for investment advice. Not that we ever call it that, but like, let's be real, that's what it is. I want to ask you, how do folks out there know who to trust? How do they know who they can come to?
Yeah, that's interesting, because there's a lot of, I guess, YouTubers out there, influencers, financial influencers out there that have a lot of really good advice, right? They have a lot of things that they talk about, and some of them are super, super smart. There's some that I could just think of off the top of my head too that are like that's like they spend all their day doing research on companies. I don't know if I'm allowed to say specific names, but Joseph Carlson is one that comes to mind.
Great
He
one.
does, yeah, he does so much in-depth research on the companies that are in his portfolio, way more than I do on mine. And maybe I should learn from him. But yeah, so there's a lot of great YouTubers out there that have awesome content, but then there's those that are, some of them might have over 1 million followers that they just don't give great advice when it comes to investing or even picking stocks, right? They'll talk about a stock that is extremely volatile, right? That will jump up 50% and fall 60% within a matter of a year, right? And they'll talk about this specific stock and say that it's like the only stock you need in your portfolio. So I think, funny as it sounds, I think it's good to diversify your YouTubers, right? So look at different YouTubers and what they're talking about and their strategies, and kind of determine for yourself which YouTuber has the best strategy that you want to kind of adopt and have in your portfolio. But yeah, I think diversifying your finance YouTubers is a good idea too.
I love that, man. Diversify your financial YouTubers. I want to dive a little bit more into your portfolio. Can you talk to us? Because we've heard a lot about Costco. So I know it's in your portfolio. What are some
Yeah.
other top dividend stocks that you have, and also some growth stocks that you have in there?
Yeah, so like I talked about before, JEPI, JEPQ are some of my favorites. I think they're great income dividend ETFs, perfect for that monthly income to help create that snowball, to continue building that snowball and increasing that dividend income. I don't know if I mentioned this before, but kind of my goal, my long-term goal is to completely live off dividends. I can't think of anything better than, sitting on a beach in Hawaii and looking at your account and seeing that, $5,000 is deposited into your account. So I think dividend income ETFs are kind of the long-term goal for me to eventually switch into that. But like I said before, I am focused on growth and tech right now, since I am since I am a younger investor and I do have a full-time job. So I'm focused on a little bit higher risk but higher reward right now. But ultimately long term, I'm slowly building up those positions in JEPI, JEPQ, SCHD. Trying to think off the top of my head which ones that I've been kind of recently looking at more. There's so okay, there's the yield max ETFs that are fun because as we've seen, the distributions on those are extremely high. Some of them are up to like
Ridiculous.
90%. So those are fun to look at. I have $1,000 in TSLY, which is the Tesla options ETF from YieldMax. And that one's fun too, because I'll make a video about it and kind of talk about the risks and kind of talk about whether or not it may or may not be a good investment long term. And it's kind of fun because people are very, very emotional about specific, ETFs and stocks. And so the comments on those videos are really funny because people get very, very angry with me when I'm just talking about a specific, asset that's just according to me. So those ones are always fun to watch. I obviously wouldn't recommend putting too much into those. Those are fun to see how much you can make in dividends. But you'll hear a lot too in the investment community and the dividend investing community that it's not good to chase the yield, right? Sometimes we'll find stocks or ETFs that have a 30 or 40% yield, and that's really attractive, and we'll want to put all of our money into it so then we can make that 30-40% every year. But then maybe the next week or the next month the company will cut the dividend or suspend the dividend, and then you're out that 30-40% in potential dividend income. And so a lot of times we get caught in that dividend trap of we'll buy a company or an ETF that has that super high yield, and maybe it'll fall 10%, and then that yield will be cut or suspended, and then we're out 10% of our capital. Yeah, I think it's important not to just chase the yield and focus on kind of that blend between growth and dividend yield.
Sure. What are some of the growth stocks that you have in your portfolio that, as a younger investor, you kind of have the benefit of time to just
Yeah.
strictly go growth?
Well, I of course have the classic Apple and Microsoft. Those are my top two holdings, and we all of course know about those two. They're extremely popular. Worth they're both worth nearly $3 trillion. So I have those two. Those are my top. I have about 21% in each, and then just off the top of my head, I do own Costco that I've talked about. I'm kind of trying to get a little bit more into semiconductor companies. Those, as we've seen last year, have just been on fire, right? Nvidia, Broadcom, all those semiconductor companies. To me, they're extremely hard to understand. The business models are very, very complex. The only thing I know about them is, they create these chips or these semiconductors that are in basically every technological device out there. So that's about the extent of what I know. And I'm trying to learn as much as I can. Like we've talked about, it's kind of this journey of learning as much as you possibly can. And so what I do with my videos too, and with my content is I try to just say, hey, I'm doing research on this stock or ETF that I find interesting. And that doesn't mean I'm a genius about it. It's just I'm sharing what I know. So yeah, I'm trying to get more into software and semiconductor companies, as hard as they are to understand and as complex as they are. I'm trying to learn as much as I can and not being too risky with that. But like I said before, that I do like to kind of target certain specific sectors. So right now, the semiconductor sector has just been on fire, and it's, in my opinion, going to continue to grow over the next 2, 3, 5 years. So that's kind of what I like to do is target a specific sector and learn as much as I can about the sector, about the companies that are in that sector, and invest accordingly, right? Invest based off of what I know and learn about the company. And even when a lot of it goes over my head, I still know that, hey, this company continues to increase its cash flow. It's continuing to beat its earnings. It's a solid company that's worth, 300 billion. So I know that this company will do well, at least for the next 3 to 5 years. So I'm going to invest in it, right?
Sure.
But of course, it's always good to, you'll hear this a lot too, is it's always good to understand as much as you possibly can about the company before you invest. And so that's what I've kind of recently been trying to do a lot more with
Sure.
these semiconductor companies.
So even with the companies you mentioned, I mean, it's interesting because you talked about Apple and Microsoft, Costco, all of which, by the way, do have, in fact, a dividend. Do you have any stocks in that portfolio of yours that actually don't pay any dividends whatsoever?
I actually don't know if I do. Um, Google doesn't pay dividend, does it?
It does.
I think
Not yet. I mean, very well
okay.
may, I feel like in the coming years.
Yeah, so
You-
so Google, I have about $1,000 worth of Google. I'd have to look at my portfolio again, but probably 90% of them do pay a dividend. Yeah.
Sure. Sure. And now when you're looking for the dividends, because I know you talked about not chasing yield, is there like a sweet spot with the yield that you look for? Like for me, I know it's
Yeah.
actually from 2 to 3%, I feel like is a good window for me because that
Yeah.
allows for opportunity for growth. I think the highest paying dividend stock when it comes to the yield is actually Realty Income at 5 something%. Do you have a sweet spot or a window that you look for with the yield?
Yeah, I would say it's about 3 to 5%. There are different strategies with specific ETFs, like for example, the ones I mentioned before, JEPI, JEPQ. Their strategy is focused on dividend income, that monthly income. So their yields are going to be a little bit higher, but you're sacrificing that capital growth, right? So for example, JEPI, its price has stayed around $50 for about a year now, but its yield has stayed around 8 to 10% over the past 1 to 3 years. So it kind of depends on the specific asset that you're buying. Like I said, those ETFs can focus only on dividend income, which would make their yield a little bit higher. You also find that too with BDC companies. So I'm trying to think of a specific stock, but you might find a stock that has a yield of about 10 to 12%. And those are typically BDC companies because that's, again, they're focused on that monthly or quarterly cash flow that they pay out in dividends. But usually when there's a higher yield, you're sacrificing that capital growth. So yeah, I think the sweet spot, especially with ETFs like SCHD, is around that 2 to 5%. Because that
Sure.
way you're not sacrificing that growth as well to help, ultimately grow your portfolio.
Sure. Now, how much monthly, on a monthly basis, income are you bringing in from dividends?
So this month was good because of that special dividend from Costco and of course my monthly dividend ETFs. So this month was over 200. So I'm averaging
Heck
around
yeah, man.
150 to 200. Yeah. And there's another guy I follow on YouTube and his strategy is really, really interesting. It's very high risk, but it's interesting because it's high risk, but it's full dividend income. So he gets into like borrowing margin to buy more income paying stocks and ETFs, and he does have a lot of the yield max ETFs. So he's borrowing on margin $120,000, but he's using that to buy more income and kind of creating that cycle. So it's kind of an interesting strategy that he has. But again, he has a lot of those yield max ETFs, so it's still very high risk. But yeah, some people just only want that full dividend income and they're willing to borrow money to create even more dividend income and take on a lot more risk. So it gets really interesting too. There's a lot of different strategies. Um, But yeah, I think down the road, like I was saying, is the goal is to have that, dividend income completely replace my active income from my job. And so I'll eventually kind of switch from that 70/30 growth and dividend paying, 70% growth, 30% dividend paying assets to 70% dividend and 30% growth down the road. So
Sure.
hopefully, in a couple of decades from now, that $100 a month, $200 a month will eventually be five to $10,000 a month.
Sure.
That's
You
kind of the
know, what I
goal,
have to
right?
say is, again, for a 26, 27-year old, $75,000 there in the value of your portfolio, dividend income coming in around 150, $200 a month. I'm very impressed. And like I said, you've
Thank you.
surpassed definitely some other creators who are out there talking dividends and some older investors who are out there talking dividends. So all very impressive. I want to know when it comes down to your future plans, right? Because you even keep mentioning, I can't wait for that day, right? What is kind of the long-term plan? No one really just retires. Do you have anything you work
Yeah.
on the side or want to continue to, execute on?
Yeah, I always think about the dream, right, would be to completely be financially free, living totally off of dividend income, and then continuing to make YouTube videos about it, right? So that would be like, and that's probably the goal for a lot of finance YouTubers is to not only talk about dividend stocks, talk about their portfolio and, the market in general, but also do YouTube as a full-time thing. So even if it wasn't that much income just from YouTube, I think it would be awesome to, be living off dividends completely and then doing YouTube as kind of like my full-time thing, just talking about my portfolio and talking about the market. And, by that point, maybe I'll be a genius in the market. So that's kind of like, and that's probably like the same goal for a lot of us finance YouTubers is to, have a huge portfolio and show others how to get to that point, right? And that's we talked about Joseph Carlson a little bit. I think that's kind of where he's at, where he's really, really smart, does a lot of research, talks a lot about his portfolio. In fact, I think every single one of his videos is about his portfolio and the stocks that he's investing in. And yeah, he does really well that way. And so I think he's a good example of how awesome it would be to kind of have that type of career, right? Because I don't know about you, but I'm kind of obsessed with learning more about dividend stocks and dividend, ETFs and different companies that pay a dividend. So I think yeah, that to me would be like the ultimate goal is just to be able to talk about it because I could talk about it all day, right? And it's really fun to just think about how, when I'm buying these dividend paying companies, I'm literally buying income and creating that potential freedom down the road when I do buy these ETFs or stocks and ETFs.
Sure. Man, I can hear that freedom bell ringing. And I want to ask you, if you were to look back now, right, your history of investing, I want you to go ahead and just imagine for a second here, you have the opportunity right now to give yourself, right, almost go back in time, look yourself in the mirror and give yourself investing advice. What piece of advice would you give Davis Watkins about 10 years ago?
Yeah, I would just say, don't be stupid. Don't trade. Don't even look at options. Don't do anything that is considered gambling. Just do it the right way. I would basically show myself this is how you do it. You diversify, you keep it consistent, and you pick the right stocks and ETFs that will grow your wealth, that will build up your portfolio. And as hard as it is because when someone starts really small, it's probably really hard. Maybe you only have $100, right? Maybe you only make $1,000 a month and you can only put in $100 a month into your portfolio. It's really hard to see the end goal and see how far you can come and how much you can build up your portfolio. Like, 10 years ago, I would never have imagined that I have $75,000 in my portfolio now, right? So I think starting small is honestly really important to learn as much as you can when maybe you only have $100 portfolio and just keeping it consistent. And it really is like a growth machine. The stock market is this awesome machine that can literally create wealth for you as long as you're doing it the right way and being extremely patient and extremely consistent, like we talked about before.
I love that, man. It almost comes full circle. Perhaps not an ATM, but a growth machine, even better
Yeah.
than an ATM. Now
Yeah.
I want to zoom out with you a little bit. Before I get to this last question, which is my favorite one, I want to ask you a macro related question because you already touched upon macros. Now, I am a huge macros matter type of investor, which is just to say, right, that when I'm looking at the stock market and understanding these macro trends, I get to kind of set my eyes on sectors and stocks that may become ripe for investing into. When it comes to macros for you, do you use macros at all in your investment decisions? How much do macro factors weigh in? Do they even matter?
Yeah, that one's hard because it's so hard not to like listen to the news and take into account what the financial news is saying. Because as you probably know, a lot of the time financial news and these macro conditions and kind of the news based off of macro conditions is extremely negative and just puts into your head, hey, this factor in the macro is is making me want to sell, right? So for example, in 2022, I was everyone was kind of panicking, right? The stock market was down like 20 or 25%. And there was all this news about how we're going into a recession, we're going into a bear market, it's just going to get worse. And, you know, I even started to kind of panic a little bit too. I thought we're down 20%, it could probably go down another 20%, right? So I was kind of panicking a little bit. I was trying not to buy too much, to invest too much. So I was actually building up my cash position a little bit too much in 2022 because I was worried because I was reading about all these different factors and macroeconomic conditions and reading too much into the financial news because as we know that's very it's always going to be negative, right? It's always going to say we're going into a recession, we're going into a bear market, the market's going to fall another 15%. And so I think you kind of have to take it with a grain of salt, right? Obviously there's things like the Fed rate cuts, rate increases, inflation, inflation data, macroeconomic data that we can read into that can kind of give us an idea of what could happen in the future or in the short term. But I think for the most part, again, you can read into that and you can, make some changes to your portfolio based off of your research and your studies. But I think for the most part, it's good to just tune it out and to stick with that extreme patience, extreme consistency, and building up your portfolio and reinvesting those dividends. Because that can really hurt you if you're listening too much into what YouTubers are saying and what the news is saying, and it can kind of create too much fear and force you to do things that you might regret long term.
I love that answer, man. I couldn't agree more. I think the scariest headlines are, of course, our everyday headlines when we get the stock markets collapsing. I don't know, a Jamie Dimon quote of an economic hurricane coming,
Yeah.
and you're like, what the heck is that? Right? Like, how do you
Like another
prepare
one
for
of
that?
these. Yeah. Yeah.
Davis, I have one last question for you. I'm excited to ask it to you because you are almost 27. It's almost like a virtual birthday gift that I'm actually not going to go ahead and give to you because it's fake. But if I were to give you 10,000 virtual dollars right now, right here on Masters of the Market, and you had to pick just one stock, could be dividend, not dividend paying stock, doesn't matter, just not an ETF, what stock would it be and your why?
All Bitcoin, everything into Bitcoin. I'm just kidding.
Back to that gambler
Um,
mentality.
that's actually a tough question for me because whenever I get paid and I'm about to put money into the market, the first thing I do is instead of just buying one stock, I like to just spread it out into pretty much all of my holdings. So sorry, this is kind of going to be a long-winded answer, but so whenever I get paid, whenever I'm about to put money into the market, I usually just put about $75 into each of my holdings, or at least the holdings that I've been watching closely and I want to build up more of my position in. So if you were to give me $10,000, I'd probably put, 2,000 into Apple, 2,000 into Microsoft, 1,000 into Broadcom, another 1,000 to Costco. So I probably wouldn't pick one stock realistically, but I mean, if it just had to be one stock, probably Microsoft.
I thought it would be
And I hope that's
Costco.
not, or Costco. Yeah, that's a
Yeah.
tough one, but I'm leaning towards more Microsoft. Yeah.
Why Microsoft over all the others?
I've just seen Microsoft. It's extremely valuable, right? It's almost a $3 trillion company, and some people argue that the growth will start to slow, but I think with just all of its revenue streams and its scalability and its ability to just continue to adjust to market conditions and dominate in its market, I just think stocks like Microsoft, companies like Microsoft, kind of those software tech and AI companies will continue to just explode over the next 3 to 5 years. I can't say where Microsoft will be in 5 years. It might be very stagnant. Some of these extremely valuable companies start to kind of stagnate a little bit. But I don't think that's the case for Microsoft. I think it will continue to grow. I think it'll have those double-digit returns over the next 3 to 5 years. And again, I don't know about 5+ years, but at least within 3 to 5 years, Microsoft is going to be a dominator for sure.
I am excited to see where Microsoft may or may not be when that time comes. Now, investors, I want to have you join me in thanking Davis and joining us on Masters of the Market. It's been a real honor and privilege to have you on. Go check out again Davis's channel. A lot of insights are there. Dividend stocks, growth stocks, everything there in between on Davis's channel. Davis, thanks again for joining us. And
Of
investors,
course.
until the next time, we will see you all there.